Our next guest says this U.S. earnings season is going to be a tough one, but profits will improve throughout the year. Joining us now is Erin Gibbs, Senior Partner and CIO at Main Street Asset Management. Erin, always great to see you. Of course, we knew that this was going to be a difficult one. Yep. Anything that stands out to you? Any standouts in different sectors that you're watching?
Overall, we're looking obviously at a profit contraction. The communications, services, materials, real estates, sort of those guys are expecting some double-digit contractions, like we're talking 20, 30% from last quarter. So any positive surprise, anything that might make them look better going forward in the year, that might be an opportunity. I think the one thing that is really bright, the one area bright spot for Q1 is airlines. They're looking at a 74% profit increase. Now, I know these stocks have really already had a big run up. Delta already came out. Those guys really need to hit their numbers because with that kind of positive expectations, we want to see that guidance going forward.
We had seen this concentration and especially valuations being run up with some of these growth stocks. But this month, it seems value is trying to catch up. Do you have any preference there?
Right now, they're really trending very closely. It's also been part of this sort of lower volatility period. For the past 2 weeks, we've really seen the markets come down. We've seen nice smaller moves like 3 basis points, 2 basis points, just sort of ho-hum. And so therefore, obviously, both growth and value have been trending very much in line. So I think it's really about finding just individual stocks you think are going to carry through the end of the year. I'm not necessarily saying that growth or value will be the either one to play because they've been changing in preference so quickly for so much of the year.
Do you have any assumptions when it comes to the state of the economy or what the Fed does?
Yes. So I think, one more hike, I think, is expected. We know that, with the last inflation report, we are getting closer to their target, and they should stop hiking, 3 months before they hit that target, or at least take a pause. I think I'm in the camp where we expect some type of small recession towards the second half of the year, but a recession, especially we're talking something small where it's 2 quarters and very small points, doesn't mean that companies necessarily have to lose money or contract. So the GDP growth in the U.S. doesn't necessarily match what you're seeing, particularly in your large cap stocks. As much as we talk about that, I want investors to remain aware that it's not a perfect correlation and there's still opportunities in the stock market.
Does that mean you're looking for stocks that are recession-proof, or are you looking at names, I know that you're sort of not sector-specific or even growth or value wholesale, right? You're looking at stocks like Apple because of what you're seeing on their balance sheets and the prospects for growth even through a potential recession?
Yes, and I'm looking more at really about credit tightening. And we saw that a little bit with some of the reports from the Beige Book and what Kathleen was talking about earlier. But as we're going through any type of recession, as we're still looking for rate hikes, credit tightening from the banks is going to be something that we should expect. And so companies that have very strong free cash flows don't have to go to the bank, don't have to go get new loans. Those are the companies that tend to do well in those credit tightening environments. And so anything that has great free cash flow along with like a good value and a good free cash flow yield, those are some of the winners that I'm really looking for to get us through to the end of the year.
What do you like in the rest of the consumer-facing space?
So consumer, actually one of the high free cash flow areas that I like, surprisingly, is Chipotle. So it's a little unusual. Most fast food restaurants don't quite have those types of ratios, but that's one of my winners. Another in consumer space, transports, I still like the airline stocks. I like European airline stocks like Ryanair. And then another area is luxury, the high end. So that's part of the China reopening. It's part of pent-up demand. And then we've also seen that at the high end of the spectrum, even in the U.S. as well as in Europe, the consumer is still very much willing to spend. And so LVMH is also one of my picks for playing off of the luxury type of spending.
Yeah, I was going to ask if it is the European luxury names that you still prefer. So you still see further ramp up for the likes of LVMH, Richemont was another one, even as they've outperformed so much this year?
I think they still have room to grow. I don't think we've seen the full extent of where they can be. Obviously, they were doing quite well while the dollar was weakening, but they've still been outperforming even as the dollar has come back. And so even as we might see some tightening through the ECB and more rate hikes perhaps even later than when the Fed stops in the U.S., I think that those luxury brands, because they are so well diversified, they just have so many brands underneath them. It's not just handbags, it's not just champagne. I think that's one of the areas, particularly as we see more global reopening, they still have room to outperform and their stock prices room to increase.
Erin, always great to have you with us. Erin Gibbs, Senior Partner and CIO at Main Street Asset Management. And you can